Hey, Archie, the internet is telling me that I can buy a life insurance policy and become my own bank.
Well, Rob, I sure wouldn't bank on it. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, certified financial planning professionals, Archie Hoxton and Rob Hoxton. And today, we are going to do another reaction video on a specific topic that is all over social media. And it's kind of controversial, especially with financial professionals and anyone who kind of spends time in the arena. And it's life insurance, and specifically life insurance loans, and a concept, or I should say a marketing tactic called infinite banking, or, be your own bank. And so this is a video, and, disclaimer, I've seen this guy all over the social media, TikTok. You've probably seen him too if you kind of go into the real estate investing world in that part of TikTok. He's not really giving great financial advice. In fact, it's rather atrocious.
It's interesting because he gives a little nugget of truth, but the way he presents it, is patently dishonest.
Yeah.
And designed to separate you from your money. But there is truth, and it's throughout the video. There are little bits and nuggets of truth, which makes it confusing, I think.
Yeah, but also makes it easy to kind of listen to and potentially, take action on it. So let's go ahead and dive in. We'll start reacting to this.
When you put your money in a bank, you know what the bank gives you as gratitude? They give you like 0.0 nothing % return on your money. Instead, I put my money in a whole life policy.
Yeah.
That's your first sign.
Yeah. Well, there's a couple of things there, right? And to make a comparison of a bank and an insurance policy, it's a false comparison to begin with because they're so radically different from one another.
Right. And my bank doesn't give me 0.0 nothing on my deposits. Yeah. I think I'm earning something substantially more, 4.5%, 5% right now. This is being recorded at the end of July of 2024, and those rates change. But yeah.
And you're not paying a gigantic sum of money every year to be able to have the account. There may be some small fees. But that's the thing with a whole life policy. You're paying a premium because it's an insurance policy, and you're paying for insurance that if you die and the policy is in force, you'll get a death benefit of some sum. And you're paying for that.
And we should say, I love insurance. I have more insurance probably than I need. And it's because I've seen what insurance does when people are at their worst.
Right.
I've seen a life insurance policy that makes sure that a young mom and her little children get to maintain their lifestyle, get to go to college, get to do all of these things.
Paid off house.
Yeah, I believe in life insurance. What I don't believe is in what you're going to see in just a minute.
Yeah, absolutely. It's because it's important to keep in mind, insurance is insurance. Start with that. It's not really an investment.
I'm talking about a strange, bizarre type of life insurance. Let me tell you what I call it. It's called high cash value policy. This is money where you put it in and you can almost immediately take almost all of it right back out, just like a bank. But guess what happens when I put money in this special savings account? Number one, I don't earn 0.0 nothing %, I earn 4%, but then I also get a 1 to 3% dividend.
So he gets 4% plus a 3% dividend. That adds up to 7%.
But it doesn't actually work like that.
No.
Because he's mixing up a couple different concepts and assuming that applies to life insurance, cash value life insurance broadly, but it doesn't. Right? So not every policy is going to pay 4%. Some policies have provision that maybe it doesn't earn anything because it's participating in, stock returns, for example, or bond returns.
Well, and this guy has one that's paying 4%, plus it has dividends on top of it of 3%.
But that's another thing, is that not every kind of policy does that. Typically, you have to have a mutual company life insurance policy, which is where you are a shareholder of the company and you make those dividends. But normally those dividends don't go to your cash value.
Right.
They go to paid up additional insurance.
So yeah, and this isn't a strange new kind of insurance. Whole life insurance has been here for a very, very long time.
Yes.
Yeah.
It has been marketed 1,000 different ways. And that should tell you something. If it's that hard to sell, that you've got to find a bunch of ways to market it, that maybe not everybody actually needs it.
Number 3, it grows tax-free. Number 4, I can borrow that money at plus or minus 1%, basically for free.
Okay. Yeah, basically for free. No, you can't. And you're not borrowing it from yourself. And you're not borrowing it from the policy. You're borrowing it from the life insurance company.
Right. And this is the thing. That is, I think, at the heart of the misconception of the infinite banking concept, is the idea that you're borrowing from yourself and you're paying yourself back. But you're actually not. You're borrowing from the insurance company, and the cash value in the insurance contract
is the collateral. Yeah.
Yeah. And so that gets you potentially a preferential rate, because if you don't pay it back, they can seize the cash value and cancel the policy. And
any interest or dividends that you receive, it's true, those are potentially tax-free.
Yeah, potentially.
But we'll learn in a minute that in many cases, they're not tax-free. They're tax-deferred.
Right. Yeah, yeah. Now, the death benefit is going to be tax-free, but that's if you
have to die with a policy in force.
Exactly. So this is what we mean. There's little pieces of truth, things that are attractive sprinkled in, but then there's some things that are misleading.
The other thing that he says here is that you can basically take out almost all of the money that you put in year one and borrow that from yourself. Well, understand that traditionally life insurance policies, whole life insurance policies, have a commission, right? This guy's getting paid something to do this. He is going to get paid a commission, and typically those commissions actually exceed the first year premium.
Right.
Right. So really, the math doesn't really work.
Right.
You really need to pay premiums for some time in order to have a cash value that you can borrow against.
Or in certain types of policies, you can overpay the premium early on, and then you would have cash value that could potentially exceed that, but you'd have to pay quite a bit.
Yep. And you might end up creating what's called a modified endowment contract, and then you lose your tax deferral. I mean, these things are complicated.
Yeah.
Guy's oversimplifying it.
Way oversimplifying.
Yeah.
Absolutely. Another thing that he says here that is important is he talks about borrowing basically for free, and he says plus or minus 1%. What he's referring to is that you pay interest on the loan, but you also earn interest on the cash value. And if you take the net borrowing cost of that, you say if you're earning 4% on your cash value and you're paying 5% in interest on the loan, then that's a 1% net borrowing cost. But again, the insurance company is still making 5% in interest, right? And paying you 4%. And so this idea that you're borrowing for free, that you're coming out ahead, it can be an attractive way to borrow money if you already have the policy. But the presenting this as serving as your own bank, I just find that to be really dishonest.
Yeah.
And leaving a lot of important details out.
Yeah. I mean, having a mortgage on a house works the same way.
Yeah.
Right?
Yeah, absolutely. Yeah. You could do the same thing with a brokerage account.
But it doesn't have the same potential catastrophic financial situation if you allow the policy to lapse, which we'll get to.
Yeah. Let's keep rolling.
And all I'm doing is paying the policy back. And then number 5, if I die, any of the assets I bought, they get paid off because I have a death benefit.
Okay, here's the problem. If you die and that policy is in force, then the death benefit will be reduced by the amount that you owe the insurance company. And that amount could be huge. Take the example that if you have a policy, you borrow $30,000, and for the next 40 years, you allow the cash value to grow. And if it's able to pay in his best case scenario, pay the cost of the loan. What's happening is that loan is getting bigger as the cash value goes up.
Right.
If you live long enough and you're not paying in additional premiums, what's going to happen is that policy is going to lapse. And when that policy lapses, you get nothing.
Yeah.
Right? But you owe a tax bill on the entire value of that loan. That's treated as a capital gain.
Right. Yeah. Well, and because what happens is the policy lapses because the insurance company doesn't want you to get upside down where they no longer have collateral for a portion of the loan that exceeds the cash value.
In that way, that's one of the only ways that I can think of that the insurance company acts like a bank.
Yeah.
Right? The bank doesn't want to loan more than the asset is worth, nor does the insurance company.
Which is reasonable.
Yeah.
And so, but your cash value goes to pay off the loan, but you get nothing back, but you still owe taxes on that distribution of cash value, and that went to pay off the loan. And so it is a really bad deal if you allow that to happen. You pay tax, you've got nothing to show for it. Yeah. Yeah. So, I mean, and that covers it for this video. And I guess one of the main takeaways that I would have from this is you have to be so careful with buying insurance for some other reason than the death benefit. You know, there are plenty of reasons to buy cash value insurance and really good ones. You know, maybe you have a child with special needs that's going to rely on you financially for the rest of your life into your old age. Then you probably should have insurance that isn't going to expire as long as you make the premium.
Yeah. The problem with term insurance is that because every year you're paying the cost of insuring your life, the mortality cost of insuring your life, those premiums become prohibitively expensive when you get into your 70s and 80s and maybe 90s. So if you have a permanent need for that insurance, if somebody that you love is counting on that money, then you got to use a permanent type of policy. And that's one that has a cash value. And the idea behind the cash value is it allows you to prepay future premiums. Those prepayments are accumulated as cash values or paid up additions or some feature in the policy that can grow tax deferred.
Yeah.
The reason you have the tax deferral is because the government recognizes the social importance of that life insurance policy.
Right.
They're not offering you a tax benefit because they want you to get rich on it. They're offering you a tax benefit because they want it to be easier for people to provide insurance for the folks that they love and care for.
Yeah. And it's a great thing that feature of tax deferral or tax-free death benefit is allowed. Now, another thing about cash value that I think is important to know, because it's often sold as a feature, but really it's actually a requirement that allows the insurance company to offer insurance, often now until all the way out to the age of 120, right? So what happens if you think about it, when you first buy a permanent life insurance policy, say you're in your 30s, and when you make that first payment, the amount that the insurance company would owe you, let's say it's a $500,000 policy. Well, they might owe you a $500,000 if you die right away. That's a huge commitment. But the risk that you die at that point in your life is also pretty low. As you age and the risk of your premature death increases, the cash value decreases the net amount at risk that the insurance company has. And so that's how they manage the risk and can keep your premium level when the cost of insuring you when you're 75 is astronomical. They've got the cash value there to protect them. So that's why if you have $500,000 policy.
Government requires that those are reserves that are required to be held by the insurance company so that they have it to pay the death benefit.
That's why if you have a $500,000 policy and there's $300,000 in cash value, you're not going to get $800,000 from the insurance company, right? You'll probably get $500,000. It may be more. It depends. There are ways that your death benefit increases. but it's not going to be the combined cash value and death benefit.
Yeah, the insurance company is effectively giving you access. So if you were to cancel the policy before you die, the insurance company and the state insurance commissions are requiring it that they return a portion of the funds that they've reserved for claims paying purposes.
Yeah,
it's called a non-forfeiture benefit, and they're basically refunding a portion of what the insurance company collected to make sure they were solvent enough to pay your claim.
Yeah, absolutely. Well, and just to be clear and to kind of start to close here, the borrowing against your policy, we're not saying that it's a bad thing.
Yeah, there are cases where it makes sense.
We're kind of ripping on the marketing tactic that's like you should buy whole life because you can borrow from it. That doesn't make sense. But look at it. Look at all of the tools in your toolkit. Look at your home equity. You can borrow against your home equity. Look at your brokerage account. You can borrow against your brokerage account. And then look, if you have a whole life policy or some other cash value policy, that's another place where you can access liquidity if you need it, and there's a good reason to borrow. But be careful about buying something for, a minor feature rather than its true intended purpose. So, well, I think that just about covers it for today. So if you like this, leave us a comment. Ask us some questions. We've got our phone number up here. You can give us a call. You can set an appointment for a consultation. But yeah, subscribe, share with your family and friends, like the video, turn on notifications, and we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.